what we're basically talking about is two different ways you could buy a car. You could put money in a bank account, or you could put money in a policy and you could buy the car. What's the difference between you saving in your 401k or you saving in this? Nothing. You just change where the money went. What's the difference between you saving in your savings or checking account versus saving in this? Nothing. Change where the money went. So who are you writing the check to? Isn't it you? Isn't it your banking system? Right. So why wouldn't you want to make payments back to yourself? Because your money is going up through compounding. The loan balance and the interest charged on it is going down. The cash option is right up there with the lease. It just makes no sense. None at all. Welcome back, everybody. It's another week, another wealth webinar. I am joined with Mr. Snaggy in the house, Stephen Nagy, my partner in crime for all these wealth webinars and our earlier show, which is What the F Happened. Many of you probably joined us there. It was a pretty epic show this morning. Thanks for all your comments. But today, here's what we're going to talk about. We had some people in the comments in the chat saying, I thought this was about real estate. It is about real estate because real estate's the engine. Real estate's the backbone, the stable. But here's what we're going to talk about today is we're not going to focus the entire webinar on real estate because I felt this was an even funner topic because I don't know any real estate investors that also don't need a car to drive around to those real estate sites, right? What we're going to do today is we're going to do a real life case study. So I've got a really good client, pretty wealthy guy. He's in real estate. He's in a lot of other things. He lends money. He's got a great business and he got a hold of me recently. Now, he's already a client on the infinite banking side of things, which we'll briefly cover infinite banking. So if anyone doesn't know what the infinite banking concept is in the chat, if you could real quick just write IBC and put it in there, because I want to know, do I need to go a little deeper into the concept and what it is we're talking about before we solve this client's problem? So we've got this new team that we're putting together. It won't be ready probably for another 60 days. So please do not ask for it. It is not available. You cannot get it. Don't even ask. 60 days from now, we should have this ready to roll out. We don't even know what the name's going to be, but the working title at this point is Blueprint Done For You. Okay, that's the working title that we're going to use. This team is designed to solve your problems. It's what we do. So when this client brought this case to me, and here's what he said. He said, hey, Chris, I want to buy a new Tesla. And I want to know the best way to do this. And I said to him, and I'm not going to use his name, but I said to him, I said, you know how to do this. You've seen the videos. You've seen my trainings. He's like, no, I totally know that. But hear me out. He said, I've listened to you so much that I didn't just, I don't want to know just how to buy the car. I've already taken money from my IBC policies, lent it out through private money clubs. Specifically, he lent it out to ROI Properties Group, which is Rob and Nicole Fuller. Many of you know the Fullers, but they're one of our premier borrowers. They do such a fantastic job. So he lent money to them, and he's getting 14%. Okay, so he's getting 14% return on his money. So then he's got this income coming in from the money working for him. And he said, but Chris, here, let me lay this out. There's 3 different ways I could do this. I could pay cash for the car because I have the money. Okay. I could lease the car, which is this is what he was leaning toward. I could lease the car because I've been with Tesla for a while. This isn't my first car. They give me an intro rate on my lease. It's only 3.99%. And Chris, as you know, if I take money from my policy, from the specially designed whole life, they charge me 5%. So 3.99 is less than 5. Steven's already grinning because he's like, oh my God, did he not watch my part of the video where I talk about the car and the really good bank and how you make more, earning than you do earning 4 when paying 6. And anyway, but he said, so why would I take money from the policies to buy the car when I can lease the car at a lower interest rate? And the Fullers are going to pay for the car anyway, right? So like the topic for today's training is, how many of you want somebody else to make your car payment? And I don't care what kind of car payment it is. In this case, today, we're going to talk about a Tesla Model X. That Tesla Model X sells for about $79,900. We did some research and we'll show you that. Okay, $79,900 is what the cost of this car is. So we're going to buy a Model X, but we're going to have somebody else pay for it. Who's going to pay for it? Well, the Fullers are going to pay for my client's car. Okay, but then we wanted to look at, is it better to lease the car, finance the car, or buy the car with the IBC policy and make payments back to the policy? Fair enough? That's what we're going to do today. But let me just kind of go back here and look at what came in. So we got a couple people that wrote IBC. We got Paul, Daniel, we got Marcia, and then, well, Aiknot said much love for IBC. He knows clearly what IBC is. And then we got Celeste. Hey, what's up, Celeste? So they're all asking what, they're saying IBC, which means I need to just take a step back. And I planned on doing that anyway. So for some of you that already know IBC, this is kind of just a recap. And I want to preface a couple things. IBC is very simple. It is a process. It's a process of taking back the banking functions in your life. And I always like to say that, the infinite banking concept, commonly called IBC, is not a product. You can do the infinite banking concept as a process without the specially designed whole life. Why do we use the specially designed whole life? Well, I'll get to that in just a moment, but it's because it's the most efficient vehicle that we can use to run our money through. Because what alternative do you have for your investments in real estate, in stock market, or whatever? You got to run your money through some vehicle, okay, some institution. Most of you run the money through a traditional bank, but a traditional bank does not work for you. A traditional bank works for the bank. They make your money go to work for them. Your money is not working for you. I don't care what you're getting in a bank, because I've lately been having some people say, yeah, but I'm getting 5% in a CD, or my bank account's paying me 4%. Yeah, but who cares for how long? That CD's probably a year. Okay, maybe it's 2 years. But after that, it's going to reset. Your bank account that's paying you 3 or 4, I think I've heard 5%. Anyone getting 5% on their bank account? Even if you are, it's not going to last. That 5%, 4%, 3%, if you just remember back in history, not even that far, a couple of years ago, when you were making interest and then all of a sudden the pandemic hit and you weren't making any interest, and now all of a sudden you're making interest. And a lot of people, when they're getting it, they have short-term memory. They forget that the bank follows prime. And when Fed pulls interest rates, your interest rate that you're so proud of on your bank account will go down, right? True or true? We all know this to be the fact. But the policies that we use, especially designed policies from mutually owned insurance companies that pay dividends, guarantee an interest rate for the rest of your life. And that interest rate, depending on the company, can be anywhere between 2 and 3.75%. Guaranteed, plus you get a dividend every year, and they've never missed a dividend. So that's why we technically use the whole life, but I'll cover a little bit. But you can use the process, the infinite banking concept, for anything. And let me just show you. Let me just give you an example. So I'll just use money, right? So all of you are looking at me, and I'm just holding a couple $100 bills. And, you made this money. I don't care. You made it in real estate. You made it in your job, your W-2, your 1099. You made money. What are you going to do with it? Most people are going to take the money. They're going to put it in the traditional bank. Great. Well, what if you changed where that money went first and you didn't put it in the bank? You put it into a specially designed and engineered whole life policy. Why would you ever do that? Well, let's talk about the reasons why we would use that policy instead of a bank. Number one, the policy, I already told you, pays a guaranteed interest rate, 2 to 3.75%. Plus you get a dividend, and that dividend brings you up interest and dividends. They call it the dividend crediting rate, to right around 5.2 to 6% is the highest that we have for the companies we work with. So 5.2 to 6, but we don't even really use the company that pays 6. We use a lot of the companies that pay around 5.6%. So probably most of you are already confused. You're like, well, wait a second. If one company pays 6, why would you use a company that pays 5.2? See, that's where the knowledge comes in. The company that pays 5.2 sometimes is the most favorable in the way that it works, because it's not just what you're making, it's how it's designed. And not just how it's designed, it's actually what the purpose we're using the money for. So we got a guaranteed interest rate plus dividends. All that interest and dividends inside the whole life is tax-free. Is your bank tax-free when you get interest? How about your CD? Is your CD tax-free if it's not in a Roth IRA? No. How about your brokerage account that's not in a retirement account? Is that tax-free? No. This vehicle is. And the real reason we use this is it gives us the ability to put money in, and this is only if the policy is designed properly. We can put money in, and we can immediately in the first 30 days take a percentage of that money out and use it a second time. And when we take that money out, we don't take our own money. So I don't know, 1, 2, how much do I got here? Let's just say I got $1,000. I'm not going to count it, but I got $1,000. I put it into a policy. Okay. Now let's just say I've got a credit card that I want to pay off for $500. So what I would do is I would take $500 out of the policy as a loan. 500. I take 500 out of the policy as a loan, and just think of it as a circle. It's going to go around the top part of the circle. The money starts on the left side. It's going to come around the top part of the circle, and I'm going to pay off Visa. Every month, I was paying Visa $100 trying to knock that balance down. And Visa was charging me 20%. And 100 was the minimum, okay? Just go with the numbers. So what I'm then gonna do is pay Visa off. Now I no longer owe Visa any money. But if I wanted to actually be the bank and do what banks do, I would then change the name on the check. I wouldn't write Visa anymore because I don't owe Visa anything. I paid them off. But I still want to recapture and recycle the 20% that I used to give. So instead of paying $100 to Visa, I take and write a check for $100 or set up a bill pay for $100 around the bottom part of the circle. And where does it end? Back in the policy as a loan repayment. Now, you all just followed that. It wasn't hard. 1,000 went in, 500 came out. It paid off a debt. I took the amount from the debt and I rolled it back into the policy as a loan repayment. But what you didn't understand is that all of the money, all $1,000 that I had in the cash value in that policy is earning interest and dividends, even though I took the $500 out. So most of you are thinking, wait, 1,000 minus 500, there should have only been 500 earning interest and dividends, but Chris just said there was 1,000 earning interest and dividends. So wait a second, whose $500 did I take? You took the insurance company's money. The insurance company's general account lent you $500. And why would they ever do that? Because that 500 doesn't even need to be paid back to them ever, for that matter. So why would the insurance company do a loan to you of $500 that they don't ever want back? Well, that's kind of a white lie, because they do want it back, but they don't care when it comes back to them. As a matter of fact, the insurance company is fine if you wait until the day you die, because the day you die, that insurance company promised to pay you a death benefit, tax-free. So they just take the $500 away from the death benefit they're going to pay you when you die, and they're cool. They're like, good, we're done. You know, Chris put 1,000 in, Chris took 500 out. We gave him $500 of his death benefit early. Chris lived 50 more years and died. We just take the 500 back when he dies. We don't care that it took 50 years because we charged interest for 50 years. So there, most of you are like, I knew there was a catch. They're killing you. They're charging interest. They're those scumbags, those blood-sucking insurance companies. But the interest they charge you was 5. How much did I say you're earning? 5.2. Let's just use the low one. You made a spread. And every year, because your money never leaves your account, it compounds. So every year you got more money compounding, which means your spread goes up. So every year you make more money in a spread. So by paying that credit card off at 20%, a lot of people think I got 20% back, but I actually got 20% plus the spread that I made. How do banks operate? You give them your money and they give you an interest rate. Sometimes they take your money and make it go to work for them. They lend that money out at a higher interest rate. And what do they make? A spread. Are you seeing the similarities here? What I'm teaching you is to be the bank. I'm teaching you how to take back the banking functions in your life. This was pioneered by the late R. Nelson Nash in the book, Becoming Your Own Banker. We teach how you become the bank. And I just showed you exactly how to mimic what a bank does with a very unconditional vehicle that most of you don't like, called whole life insurance. But now that we've got that out of the way, let me show you how it works. So the first thing, before we get into the cars and before we talk about the real estate and all the fun stuff, let's talk about the number one thing that most of you should do before you invest money, before you go out and spend money on real estate or put money in the stock market. Your debts. Your debts are the fastest way you'll ever get to wealth. Mark my words. Here's a real example. We did this. This is what that team, the Blueprint Done For You team, again, not available for at least 60 days, so don't ask. But this is what we did, is a beta test for a 35-year-old male who had $10,000 a year in premiums that they were putting into their policy. Here was his scenario. His goal was to pay off debt. I did this last week, so I'm going to really hit it quick, but he had Visa, Amex, a car, and medical bills. Okay, here was his interest rates, 21, 23, 7.8, and 0. And here was his monthly payments. He was really making extra payments on that Visa and Amex trying to pay it down. But he was $3,228 every month was leaving his family forever. It was going to these debtors. Okay, so what we did is we said, let's take back the money you're giving away. Let's build wealth. Let's create $3,228 back in your life without you working harder, longer, or taking on more risk. So he puts money into the $10,000 policy. Every single time he has money in there, we immediately take a loan and we pay the debts down. Puts 10 in, we pay first off, we pay the Visa off, then we pay down probably the medical, and then we would pay down the car. We didn't put these in order, but normally the system will put them lowest to highest. So here's the deal. We ran 3 scenarios, which is how we're going to start doing this, because nobody ever believes it when we just tell you this is the best way. My client, the one that I mentioned with the Tesla, when I told him the best way, he's like, I don't know. It just doesn't seem like that's the best. I mean, 3.99 is less than 5. I said, math doesn't lie. So let me just run the math. Well, that's what we did here. Math doesn't lie. You guys heard the numbers, but basically these are just the options. He could just continue to do what he's doing. He does not need to start the policy. He could just do what he's doing. He's making extra payments on the loans. This is what most people think is the best way to pay off their loans. This is what most CPAs tell you. Oh, just make extra payments to your debts and you'll pay them off. This is what the gurus and the geniuses in finance tell you to do to pay off your debt. So who's right, them or us? Well, let's let math prove it. So if you just made these extra payments and did what you're doing, you'd pay all the debt off in 51 months. You'd make payments of $105,692, and you'd pay a total of $24,753 in interest. Not bad. But what if we just organize these debts from lowest to highest? So in other words, we paid that one off first, this one off second, even though this one's 0%. Most people would fight that. They wouldn't pay this medical one off. They're like, but it's 0%. I'm not going to pay that off. Trust the math. Then we'd pay this one and this one. So we put them in that order. Who came up with this? I don't know. Dave Ramsey likes to take credit for it, and he calls it the snowball. So let's snowball it like Dave Ramsey. So if we did just that, nothing else changes. We just put them from lowest to highest balance and recapture the money that he was paying to the creditors when they're paid off and puts it back toward the debts. He pays it all off in 31 months, makes only payments of $99,514 and pays interest of $18,575. That's way better than just doing what the financial pundits or gurus would tell you to do, right? So Dave Ramsey has one up on them. But what if we just change where the money goes first and we put it into that stupid whole life policy first? And then we do the exact same thing Dave Ramsey tells us to do, except we don't use an envelope like Dave loves. We use a specially designed whole life. What would the math look like? Well, here it is. Number 3, you pay all the debts off in 30 months instead of 31. You pay $95,000 total in payments instead of 99. You pay $15,101 in interest instead of $18,000, plus you have $21,421 left in your cash value. That's freaking cool. You got an extra 21 grand. Oh, and if you die, you got $401,000 in death benefit. So which one would any of you do? What one would you do? 1, 2, or 3, folks? Put it in the chat. I mean, this is just math. But some of you have a misconception. Some of you would say, oh, I'm going to do number 2 because I hate whole life. It's okay. But see, I bet you most of you are going to go along with math because math doesn't lie, and you're going to do option 3. So this is the exact same strategy we're going to do moving forward here when we talk about a car. I got to just break this down like this, okay? So someone that was asking about real estate, this is where we're going to get into real estate, because real estate's what's going to actually fund the purchase of the car. So many of you, you probably at some point in your life or another have heard somebody say to you, the best way to buy a car is to buy a rental and take the net rental income and use that to buy your car. I've heard that before. Buy a dividend paying stock and use the dividends to pay for your car. I've heard that before. Put your money in this investment and take the interest off and pay for the car. I've heard that before. But then the real estate one falls on its face when you got a main sewer line that goes bad and you got to replace that. Oh, net rental income, 0. How are you paying your car now? You're not. You buy the stock with the dividend. Then all of a sudden the company comes out and says, oh, hey, we're cutting dividends in half. Oh, there goes your car payment. So there's a lot of holes in some of these things. So what we're basically talking about is 2 different ways you could buy a car. You could put money in a bank account, or you could put money in a policy and you could buy the car. This particular client already had the policy, which I'll show you the math. But he was looking at it from the wrong lens. Even though we watched the videos, seen the videos, that's why we repeat ourselves a lot. And some of you are probably like, I've heard this all before. But yes, but has it sunk in? Because this client, great client, very knowledgeable, wickedly smart guy. But sometimes our mind drifts back to the old way of thinking. Sometimes even though you know what we teach and you watch the videos, sometimes your mind takes you back to the old way of doing things. I had a conversation with Celeste on here, and sometimes our mind just goes back to the old way of thinking. And sometimes family members get in the way. Sometimes family members are like, that doesn't make any sense. Why the heck would you ever take a loan from a whole life at 5% when you could lease the car for 3.99? You got a lot of outside noise that comes in, right? Some of you have dealt with this. So I always say it. I said it last week. I'm going to say it again, and you're going to hear it a lot more. Just let math be the guiding light. Just let math do the work. That's what this new program is going to be. The blueprint done for you. There's going to be a lot of different options. It's just math. Some of the programs will be done for you. Like literally, you'll have a team of people doing all this for you. Some of the programs will just be a spreadsheet that you buy and you just plug numbers in for whatever your problems are you want to solve. Like the spreadsheets will be cheap, but all math. So here's the deal. This particular client is buying a $79,990 Tesla Model X. Now, I mean, I think Teslas are just a technology, like just unbelievable machine. But I don't like electric cars. So to each their own. If you want a Tesla, great. I'm not a Tesla guy, but I do love this car. And I love this car that Steven's showing because this car literally drives itself. So if you live in California, you're going from San Diego to LA, that is a crappy drive. You push a button, the thing drives there. If I'm going out speaking at an event and I get tired because I drove there early in the morning, I spoke, I hung out, I did dinner, and then I want to drive home at night. But, you know, I'm like, oh boy, I probably should sleep. You just hit the auto drive button and it just drives you home. I mean, the interior on these cars, come on, I don't care whether you like Tesla or not. They are
12,000 just for the record. It's not your 12 grand to do that, but it's
all
cheap.
right, so
why?
12 grand. What a bargain to
Just kidding. Don't
to...
let it drive you drunk. I don't think that's legal.
Yeah, I don't think that's going to get you out of a DWI. But, you know, so here's the cars, right? You know, forget about the self-driving capability, but it's still, most people would think this is a beautiful car, but this car costs.
Let's build it.
Yeah, let's build it. Let's do that. What does everybody think? Black on black? I mean, that's my style. I'm not a gray person. I like black, I like white, I like red, but let's do that. Oh yeah, go nicer wheels.
Well, we got to keep the price within his range. We're at 79, so we can't do any add-ons. So
all right, so no add-ons, but those are nice wheels. I actually kind of like those wheels better than the other ones. I don't need to tow anything.
no, it is included. It comes with the tow package.
Oh, sweet, we get to tow some shit. 5,000 pounds. I gotta do white, man. If you're gonna own a Tesla, you gotta have the white. Nah, screw that.
$2,000. All right, we'll throw it in.
Yeah, we got to do that. That's pretty. Seating layout. I get to pick how many seats I have. You could put 7 seats. Well, if you're, I guess, an Uber driver, that's pretty cool. All right, steering wheel. Oh, is there an upsell for the Darth Vader steering wheel? Only $1,000? Dude, you got to splurge for that.
Right, let's go with it. All right, no autopilot and no self-driving though.
All right, so I'm not driving home that night. I'm gonna have to stay in a hotel. Because
Right,
I'm telling you, if I amortize it, if I'm staying in hotels, it's about $200 to $300 for a nice hotel room. It's going to take a lot of hotel rooms to equal that self-driving. So I'm good.
she's pretty.
You got to start valuing your time. That's a sweet car. Anyone like that?
I like it.
Xers liking the all black inside, but I definitely think we can go with that. I mean, there's nothing like the Tesla white. I've never seen another car like that. So that's the car we're going to buy, and that's the car the client's going to buy. So we just want to kind of show that. So
and when it was driving you, if you spill your red wine on it, it doesn't even stain the white seats. It's magic. They're really magical cars.
That's incredible. Well, it's magical until you get caught in a snowstorm in Buffalo and your car battery dies. Well, we won't go there. Anyway, there's a couple different ways you can buy one of these things. Okay, you can lease it. And if you're a preferred buyer of Teslas, your lease could be only 3.99% because that's how they promote it. So on a 36-month lease with the 3.99 like loyalty credit that they give you, your monthly payment's going to be $1,250. Okay, so you could lease it $1,250 a month. You could also finance the car, and you could finance the car for lots of different terms. Stephen, did you run the financing on this?
Yeah, I have a calculator so we can play with it a little bit. Here, I'll share it.
Play with this for a little bit because I want people to see how we do this. Yes,
Right.
Aiknot, it does snow in Buffalo. Yes, sir.
So right now to get a $1,252 payment, we'd be at $79.9. This isn't including any kind of tax or delivery fees or anything. So just sticking with do you know if there is any tax or anything included here?
I do not, but I do know, whoops, there goes the G-Wagon. I do know that the interest rate on the financing through Tesla was only 6.15%.
So there's probably some tax. Maybe, do you know what state he lives in?
I do. I just put, I don't know. Yeah, put
probably some fees involved in there.
I'm sure.
Let's see, maybe a little bit less. So 1290. Let's see.
I just don't know what his tax rate is.
So if we do a $3,000 fee, 1% tax at 6.15% for 82 months, that gets us at $1,253.
So 82 months. Okay, we'll look at the financing. We didn't do it 82 months, but that's the calculator there. That's how long it would take you to pay this car off. Only 82 months. No big deal. How many of you think this car is going to last 82 months? I mean, I'm being serious. Like, has anyone owned a Tesla for 82 months? Anyone? I'm just curious. Will the battery last 82 months? Okay, 5 years.
7 years for the record.
7 years. Battery is 5 years. Okay. All right. Well, maybe. Don't try that with one of those GM electric cars. Just speaking for a friend. I don't think you're going to get 7 years out of a GM. So 82 months, what it's going to take.
They're asking what IBC is. IBC stands for the infinite banking concept,
right?
which is the process we follow when using this whole life policy to move money to let us recapture interest that otherwise would be bled away, like we're showing you right now, paying off debt quicker than otherwise possible, or it's just a warehouse of wealth where we can put our money, have uninterrupted, guaranteed, compounding, tax-free growth within the policy while simultaneously pulling the money out and using it for other means, like we're showing here right now. Let's see. All right, you're back. Perfect.
Sorry about that. Yeah, UPS came. I'm the only one here today. All right. So, 82 months. You could pay cash for the car. He clearly has the money, to pay cash for the car, but then he's got $79,900 less that he could ever have that money work. That money won't work for him if he buys the car. And then he could use IBC. And if we use IBC, the cool thing is we can set the terms. When you use the infinite banking concept, remember you took back the banking functions, which means you're in control. You set the terms, you set the rate, you set it all. So it wouldn't be out of line to do what Stephen just did and just say, hey, if we're going to finance this through our infinite banking concepts policy, we could basically pay the same amount as what the lease would be. Because why do people lease cars? Let's be real. Because the payment's lower. Because here, if we were to finance this car and I ran 72 months, I wanted Stephen to figure it out at 82 because I wanted to know how long it would take. But at 72 months, the payment would be $1,331.34, which is what Tesla told him for this car. So if we did it here, we can make $1,250 payments back to our IBC policy. So the question is do we do this or do we do this? And if we do the policy, we just got to move the cash into the policy. So let's just run the math. So I know there's a lot of numbers, but we did this 2 different ways because when we're going to run the math, let's run a lot of it. Okay, but I want to make this super duper simple. So here's a couple of things. I just want to get everybody familiar with the terminology that we're using. So the net benefit, okay, so down here we've got this thing called net benefit over here. You have to understand what that means. So we had to give you like a little template. It's the depreciated car value, and we depreciate the car by 10% per year. We're giving Teslas a lot of residual value. So we depreciate it at 10% minus the loan cost plus the cash to use again. So this is really your net benefit for these. So how we did this is we literally just assumed all 3 of these scenarios, okay, that we just went over. We assumed leasing it, financing it through Tesla, and we assumed using the whole life insurance policy. Now, why does it say CV line of credit? Well, this client has a cash value line of credit. So actually, for most of you, your scenario is going to be better than this client's because your borrow rate on your policy is less than 5.5%. So when you borrow direct from the insurance company, it's less. But you see, this client, like myself, has a bunch of policies. So he uses a cash value line of credit for simplicity. Okay, everybody good with that? So no matter what, I'm doing a disservice by showing you higher interest rates than what you'd actually realize if you did this with your policy. So that's a good thing. But here we go. Okay, if we lease it, the payment's $1,250 a month, and the amount that you would pay over the course of 36 months, which is the first one we're doing here, is $45,000. So if we look at the depreciable amount the car would be worth after 36 months, and then remember up here, so depreciated car value right here, minus the loan cost. So we come over, where's the loan cost? Okay, total outstanding loan cost we'll do right here, plus the cash to use again, 0. Anyone ever lease a car and had cash to use when you handed the car in? Did they write you a check when you hand the car in? Now, if any of you turned your car in the last couple of years, that'll be the first and probably the last time in your life you ever get a check when you turn your lease in. So to be fair, there is no cash that you're going to use. So the net benefit, if we just did that, is 19,000, but your true net benefit in a lease is 0. You got to just turn the car in, you got nothing. If you finance the car through Tesla, they have good rates, 6.15, which is significantly better than the rates out there on the street of about 7 to 8% for used cars today. So the total monthly payment would be a little bit more. Now here, Tesla had a 72-month payment, okay? So 72-month payment term, 13/31/34. So if you did that, at the end of the 36 months, your principal would be 36,511. The interest would be 11,416. So that's the difference between the two. And the total paid was $47,928 over 36 months, just making those payments. We just broke it down, principal and interest, because that'll be important in a second. And then the outstanding loan after 36 months is 43 grand. But if you've got a car that's worth 64,791 in 3 years, and you've got a loan balance of 43, you're in the money by 16,000. So in this case, you technically really do have the ability to make 16,000 as long as you can sell that Tesla for 64 grand, right? So what would happen if we put the money into the policy and we borrowed the money out of the policy at 5.5%? And let's just keep things the same, right? Let's take the best of both worlds. Well, the best of the lease is the low payment. So because we make the rules, let's just pay $12.50 a month. Okay, why not? It's our bank. We set the rules. And you know what? Since the bank was going to do the financing for 72 months, let's just do the financing for 72 months. No big deal. Let's see what happens. Knowing that at $12.50, it's going to actually take us 82 months to pay the car off. I want everybody to be clear about that, but let's just do the math this way because it doesn't matter. Here's the principal you pay, 35. Here's the interest you pay, okay, 92. So it's less interest because it's a lower interest rate. So you paid a total of 45 grand, but your outstanding loan balance is 44,262 because there's more going to principal, okay, over this period of time because of the amount. So 44 is the outstanding loan balance. The other one was 40. Sorry, I said that wrong. The other one was 43. This one's 44. So you got a little less going to principal than you did on the financing. But here's the cool part. So at the end of this, you still would have $35,727.35 earning interest and dividends. So you got cash value that you get to use again. There it is. Now, this is what confuses some people and confused my client a little bit. He's like, how would I have 35,727? And I kind of just bang my head on the wall and I say, who are you writing the check to? He's like, well, I'm writing the check to the CV line of credit. I said, who is the CV line of credit? Who owns the policy? Oh, I do. So who are you writing the check to? Isn't it you? Isn't it your banking system? Right. So all of these checks that they wrote, okay, right here, that money went back to your policy. It repaid the loan that you took against your death benefit. So how much money do you have to use after 36 months? $35,000. Now, how many of you can go back to your bank that you finance your car with and say, hey, after 36 months, hey guys, can I have this 36,000 back in principal that I gave you? Zero. So do you see the economic benefit of changing where the money goes first and just following the exact same things? What I'm showing you is identical to what you do today. There is zero change. Matter of fact, the advantage here, folks, is the change is that we're paying lower monthly payments. Why? Because why not? What the hell does it matter? It's your bank. Let's say somebody was like, well, if that's the case, then can I just pay $1,000 a month? Sure, man, no problem. You're just not going to have as much money here. It's your bank. You set the rules. You're in control. When you finance through Tesla, you are not in control. When you lease through Tesla, you are not in control. So option 3 is the only one that puts you in control. So everybody understands that. I think this stuff's really cool. I want you guys to start thinking of your questions because there's got to be someone that's trying to punch holes in the math or someone trying to punch holes in things. So in this equation for a 36-month deal, because that's how long the lease was, that's why we did this, the true economic benefit, the net benefit is $55,519.25. So which one would you want to do? Obviously this one. But let's go one step further. Let's come down here and let's look at this exact same scenario, but let's look at it at 72 months. Because some people would be like, yeah, but if you just kept the financing with Tesla and you did that, what would be the difference? Now, this isn't even close. So we're just going to cruise through this. Number one, the lease ended in 36 months. So that's not even relevant for here. So a bunch of zeros. But the financing at 615 with Tesla at 72 months was 1331. So now you paid 80,000 in principal, 15,000 in interest, a total of 95,000. Okay, the depreciated car value after 72 months is roughly 38,000. So you're in the money 22,000 bucks. This is what people are pumped about. Like, think about this. Think of all the people you know, your entire family, your friends. Like when they pay their car off, what are they excited about? They're excited about when they trade the car in or they sell the car, they got all this money, right? They got all this depreciated car value. And then in this case, what we're doing is we're just subtracting that from the total. So we're just getting you the net balance that you actually have. People get excited about this. But here's what we get excited about. And here's what I hope all of you get excited about. Given all the numbers are exactly the same. Yes, the one thing that has to happen here, and I know some of you are thinking this, some of you are like, yeah, but Chris, you're missing the 800-pound gorilla. This dude had to save $79,900 in his policy to do this. Absolutely, he did. I never said this was a quick fix. I never said this was an easy fix. I said this is the best fix. So of course, this client did have to save that $79,900. So anybody that was thinking that, look at all of your accounts. Do you have $79,900 saved somewhere else? In a 401k? Okay, do you have it saved in a bank account or CDs or brokerage account? You do? Good. That means you could do this. What's the difference between you saving in your 401k or you saving in this? Nothing. You just changed where the money went. What's the difference between you saving in your savings or checking account versus saving in this? Nothing. Change where the money went. You see, it's the exact same thing. So don't make it something that it's not. I'm trying to keep this very simple. And here, if you just did it from your policy, again, I'm hurting you guys 50 basis points because he's doing this from a line of credit like I would. So if he does this from his line of credit, does $1,250, here's his principal, here's his interest, here's the amount he paid. This is the cash he has available to use again, $77,000, because all these principal payments went back to his policy, to his bank. So the depreciated car value is the same. So what's his net benefit? $102,000. $102,000. So wait a second. How much money did he pay for the car? $79,900. And how much money did he technically get? And if you all remember what the net benefit was, it wasn't very difficult to calculate, right? Depreciated car value minus the total loan costs plus cash to use again. Okay, 102. So he made 102,689 for buying the car. Subtract the 79 from that. How much money did he make? Absolutely. Listen, like I used a cash value line of credit. Okay, you'd use your policy in most cases, which means you'd actually make more money. Could you do this with another vehicle? Like some people had mentioned a home equity line of credit. You could, but home equity line of credits are pretty expensive right now. But in the past, you could have done this. But essentially, the reason this works so well, folks, is because the policy that we're putting that money in earns interest and dividends uninterrupted. And it allows you to use the money at a lower interest rate than what you're actually compounding at. So you're getting paid more by the insurance company in interest and dividends than what you're paying them in simple interest on the loan. But not only that, there's one other thing that all of you know that I tried outlining pretty clearly here, and that is that every payment we make, whether 1331 or 1250, is reducing the principal of the loan. Therefore, when you reduce the principal of the loan, you're paying less interest month after month after month because you're paying interest on a lower declining balance. So in the policy scenario, your money is going up when the loan balance is going down. I guess I'll just do it here. Your money is going up through compounding. The loan balance and the interest charged on it is going down. But the other factor that we always try to instill in every one of you is what is the number one thing we all must do? I don't even care what your opinion of whole life is or IULs or anything. It doesn't matter. What is the number one thing you must do? Take back control of your money. Just like Nelson Nash said, take back control of the banking functions in your life, which is exactly what we just did here. But bonus round, for any of you real estate investors or any of you that know about private lending and what we did with Private Money Club, what this guy did is this guy took the money. So let's just pretend it's $79,900, which is actually more. And he lent that money out at 14%. Okay. And he did that. He lent this money out. So let's just do the math. 79,900 Okay, he lent this out at 14% because he's got enough there to get 14 with the Fullers. So Fullers start at 12% at 100,000, and then there's break points. So you can do the math. He's at 14, which means he has more than 79.9. But let's just do the 79.9 because I'm curious now. Okay, that equals 11,186 divided by 12. That's $932.17. Now he has significantly more money than that with the Fullers. So the Fullers are paying him more than enough money to pay for any of these payments. But just like think about this. If you took the $79,900 and you lent that money out at a rate of 14% on a private loan in first secured position with a personal guarantee, that's what the Fullers do, that 79.9 would give you $932.17 a month. So if you wanted a Tesla, does that not cover most of the monthly payment? Yeah. If you had to do it differently, let's just say you had 100 grand, that's easy. That's 14,000 a year divided by 12. We should be there. We're real close. 1166. So 100K in the same scenario gets you 1166. So I told you I'd show you how to get all the money back for every car you ever buy, drive, and own, including this Tesla for this client, which we indeed did to the tune of 102,000 bucks right there. But I also told you how to get someone else to pay for your car. You could have it be the Fullers. It could be Chris Root. It could be anyone on Private Money Club. I could open Private Money Club, or actually I'll have Steven do it. And listen, like we can just throw darts and we can just pick one because there's plenty of them on there that will fund your car purchase. But I'm just showing you this is what he did. You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up. Hopefully that sunk in. There's two different ways, and this client would not have done it the way that I just told you. He would never have done it this way because in his mind, he was hung up on the 5.5% interest that the cash value line of credit was charging him on his policy loan. Okay, he was hung up on that because the lease was at 3.99. And I know from the surface, it seems like 3.99 is less than 5.5. Why would I ever borrow at 5.5 when I can borrow at 3.99? But you now understand why the math is not what you think sometimes on surface level because you're doing it wrong. You're not factoring in compound interest. You're not factoring in a declining paid down balance. This software that we are designing, these spreadsheets that we're designing, does it. And we have a team that will do all this for you. Like this could be done for you in about 60 days. You just hire the team. It's a retainer. You retain the team, the blueprint done for you team, and they can do any scenario you want. You could even hire the team to do a one-off. Like this particular client could have just said, hey, I gotta figure out like what one of these makes the most amount of sense. Like, can you guys do this? And let's just say, I don't know what it's going to cost, but let's just say it was, let's say it was $500 to run this analysis. How many of you, and let me just ask you this, and this is not what it would cost for a one-off, but I'm just making, you understand what I'm getting at. How many of you would pay $500 to get $77,215 back? Literally, if it was just somebody to show you the path, would you pay $500 to get $77,000 back? But see here, he didn't get 77, he got 102 because there's still the car and you own the car in this scenario. So if you sell the car for the amount, you got 102. But you see what I'm saying? But this client, and probably many of you before you saw this, would not have done this. You would not have used your policy because I know for a fact a lot of you have been like, you got a car payment and your car payment, I'm sorry, a car loan, and your car loan's like 3%. And you're like, oh, I don't want to take a loan from the policy to pay the car loan down because it's a lower interest rate. I hear this all the time. Steven, you hear this ever?
Always.
But see here, the math just proves it. So we just created the team to be able to do this for you. That's all.
All right, we just had a few come in. I mean, one a little off topic, but what do you think about a VUL, variable universal life?
I used to own a VUL and I sold lots of VULs. So from 2003, after the dot-com crash, right up through probably to the Great Recession, VULs were the product that we sold. It was a sexy product because we could invest the client's money in mutual funds. For us, it got us a really nice commission because the commissions were basically on target and you could push the target higher because you could call it an investment, which in a VUL, the variable aspect actually was investing in directly to the mutual funds. In 2008, when the Great Recession hit, all the VULs that I had on the books went belly up because the underlying investments, the mutual funds that we invested in, all tumbled. And when they tumbled, the cost of insurance was actually more than the growth of the policy. And if the policies, many of them were not, were built directly at the target premium, then that meant that the target premium on a lot of the policies wasn't even enough to cover the cost of insurance because the policies were built so that the cost of insurance had to be supported somewhat by some growth. But when you got a market that went negative, you had no growth and the policies all pretty much were in danger of lapsing. Now, the good news is most did not because the insurance companies held them from lapsing because it was like kind of an executive decision from them to hold them, at least the company I was at. So what do I think about VULs? I think if you put money in a VUL in this economic environment where we are at the absolute top of a market, I think that would be an absolutely foolish decision to make for your money because all you have to look forward to is downside. I don't care what your illustration says. The illustration is 150,000 million% hypothetical. It means nothing. Oh, but the advisor told me, because now I can actually say the advisor, because a VUL has to be sold by a licensed financial services professional, which means they got 6 and 63 at least. So if they sold that to you with a hypothetical return based on past performance, I will remind you that in a VUL, the past performance is based on the longest bull run in history. And you're looking at a VUL at the absolute top of the market. So I think it would be awful use of your money to put it into a VUL right now.
All right. So if the same money that's needed to start the cash value line of credit or really start the policy, right, was also put to the side, then added back to the lease and finance options, what would the net benefit be?
I didn't run that math. For another $500, we'll run that for you. I'm just kidding.
I guess they're starting, like in the case of the policy, we've saved 80 grand to be able to do so. So what if we had saved the 80 grand in a savings account, I guess, instead, and then finance the vehicle, I guess?
Well, the vehicle financing, I think it was $1344. Why did I just do that entire presentation?
Or I guess what if we used the 80,000 cash instead of the policy and then paid ourselves back?
Do I have to answer this question? I'm sorry. I almost feel like I can't answer this question because I just showed you why that wouldn't make sense. Even if your savings account paid you 5%, if you take the $80,000 out of the savings account to pay cash for the car, you got no money in the savings. You're not earning 5%. You're not earning anything. Yes, you got a fully paid for car with no payments, but what's the car going to do? It's going to depreciate. Your 80 grand will become, what was the number at the end? $38,000 after that 72 months. You like losing money, clearly. So it's a legitimate question. I feel like I covered that in the training, but I could totally have missed that. But that's why you wouldn't do this. When you take the 80 grand and you pay cash for the car, sorry, the picture's not going to be nearly as good this time around. When you buy the car, the money no longer can ever work for you again. It is now sitting in a car that is guaranteed to depreciate. So that's why you don't do that. I'm sorry, that one bothers me. Am I missing something there?
I'm not sure. If you want to re-clarify if that's not.
I just feel like I'm missing something, and I feel like I'm kind of being a jerk in my answer, but I truly thought that the numbers showed why that wouldn't work.
If I borrow 10,000 and by year 2, I paid off to have a loan balance of 5,000, and the simple interest charged to me would be the outstanding balance of the 5,000. Just explain how loan interest works.
Can you just pull that calculator up, or just pull a calculator?
Well, the way the insurance company determines interest, it's on a daily basis. So if you borrow $10,000 at, let's say, 5% for 5% simple for the year, and 6 months through the year you pay it off, you're really only paying 2.5% for the year effectively because it's calculated daily. So it's the outstanding loan amount throughout the year is what they're going to calculate, and you're going to want to pay once a year on the policy anniversary date. I think that's the question they're asking, is how that works. So yes, so if you had 5,000 balance and it was the 5,000 that was out all year, then you'd be charged the 5, correct?
Yep.
How long have you, Chris, been working directly with setting up whole life IBC policies?
That's a good question, Cal. I've been, going back to my origins in the Wall Street world, 2003. So what's that? Is that 20 years? I think 20 years. a little over 20 years actually, because I started in June. So smidgen over 20 years, I've been around whole life insurance from day one all the way till now, but I didn't learn how this kind of process works until 2014 or 15 or somewhere in that range.
Can this be done with an IUL?
If you had an IUL that was out of surrender, you could, but it won't work this way. An IUL has a hypothetical return as well. So any illustration you've ever seen from an IUL is already wrong.
Yeah, the answer is
no. See, the other thing too, a lot of people, like here's where a lot of people will kind of get thrown off is they're like, well, and maybe this was that savings account question. They're like, why would I make a $1,250 a month payment when I already have the money to pay cash for the car? Because that's a legitimate question. I can go with that. So the reason is the payment goes back to you. So if you're making a payment back to yourself, the economic benefit is the principal that you're repaying. Yes, the interest goes to in this case, the bank, or in the other examples we give would be to the insurance company, but you're making payments back to yourself. So why wouldn't you want to make payments back to yourself? Because most people do not pay cash for cars. There's just, if you looked at the statistics of car buying, the majority of the cars sold in the United States of America are sold on lease or finance. I think it's a large percentage. So that proves that not a lot of people are paying cash for cars. So if you were to finance the car, this is identical because you're making the same payment as you would with the lease in less of a payment than you would financing the car, but you're making the payment back to yourself, which gives you the economic benefit of this cash to use again. 36 months later, you got $35,727 back. Okay, plus the car value. So your net benefit over here, that's why I was telling you the net benefit, 55 grand, the car value plus the cash you have to use again. But after the 72 months, which in the IBC, I want to be clear, remember at the 1250 at the same interest rate, like it would have taken you 82 months, but we just showed it like just to 72 months, you'd have 77,215 back plus whatever you could sell the car for. So your economic benefit is 102,000. But even if it was just the 77 and you kept the car, if the car still ran, that's still way better than any other alternative. And even if I did all cash, like the cash is the cash option is right up there with the lease. It just makes no sense. None at all.
Yeah, Chris Guthrie just saying he was life license 663, was trained the old buy term, invest the difference, was never taught this. This is huge. So excited.
Mm-hmm.
We get that a lot, Chris.
Yeah, I mean, I was told the buy term, but holy cow. I remember Walt Luza, who was our training director. So he was like our main training guy. So every week, we'd have 1 to 2 trainings where Walt would sit in the front of that conference room and train us on concepts. And I remember it just seemed like once a month we were learning about strategies of buy term and invest the difference. And if you invest in this, let's put the money in a variable annuity. Remember those? Okay. Yeah. Or they're still around, but like danger. Or let's put the money in this basket of mutual funds, or, oh my God, let's do this managed account. Like when I was an RIA or working with the RIA, let's do this SMA, the separately managed account, downside protection with options and derivatives. And oh yeah, it got crazy, but always protect, because from a liability standpoint, as a fiduciary, we were required to talk about life insurance because it was a fiduciary responsibility. Like if you die, your family's screwed. So we would always put that life insurance, but it was always term.
Nick was saying, get a 10 BII calculator. It's a game changer.
Okay, good stuff. We've got a calculator. His name is Craig Yenny. He's a wizard with, like, when you guys see what we've created and what he's been creating, it blow your mind. It's just wild. So I'm sure a calculator would be good, but you need that human element because somebody's got to think through.
Let's see. Dustin is asking, does the principal payment on my policy also contribute to the cash value of my policy? No, partial or all. Yeah, so when we build and design a policy for you, Dustin, it's going to consist of a few different types of premiums. So base premium going in, the paid up additions premiums going in, and then could be some term in there as well if we need to avoid MEC, depending on how it's built and if there's typically a large dump in or not. So all that money will go in, will eventually contribute to cash value. However, in the early years, the base premium does not really, because the base is going to cover really the cost of the policy and the death benefit and everything involved with the policy itself. So typically you won't see any cash value growth out of the base part of the premium for like 7, 8, 9, 10 plus years. However, when we build it with PUAs, almost all of the PUA premium goes towards that cash value. So when we design a policy, let's say it's 40% base, 60% PUA, almost all of that 60% of the total premium, not all, but almost all of it is going towards cash value. And so that's why you see when we design a policy, a lot of times we will have the PUAs on there for the first 10 years. And then after 10 years, those PUAs will fall off. And the way to look at that is kind of like a rocket ship. So I live in South Florida. We watch Elon Musk and SpaceX shoot off rocket ships all the time just to the north of where I am. And it's really cool. So using that as an example, you have the rocket ship itself, and then you have the boosters on that thing. So if we look at the base premium of the policy as the rocket ship, and then we look at the PUAs as the rocket boosters, what happens is those PUAs, those rocket boosters, are used to get that shuttle out of gravity up into orbit, up into space, where it can then float and fly basically on its own. So those PUAs get us up out of that area. So when we look at, or those rocket boosters get us up out of there. So that's exactly what PUAs do, is they give us all that cash value up front early on and create that compounding of the overall premiums within the policy. So then once that thing gets up into space, those PUAs are no longer needed, because now we're up there in orbit, and that base premium alone is now allowing you to continue to orbit the Earth. And so that base premium at that point in time, it's because of the compounding of all of the premiums, that base, now you're getting 2-to-1, 3-to-1 returns on your base that you're putting into it. So to answer your question, yeah, the principal, the majority of it is going to go to cash value in the early years, and then all of it plus some is going to go to cash value in the later years because of the compounding aspect. So hopefully that answered your question, Dustin. Maureen asks, can I lend to a trust or just an LLC?
I believe you could lend to a trust. Why couldn't you?
I don't know. I mean,
let's say, I mean, there's more risk. So if I'm a lender and I'm lending my money, lending to a trust is very risky because there's almost zero recourse. Like the trust, if it's a properly structured, like irrevocable trust, even though the asset's in there and it might secure you, like it doesn't matter. You're not getting it. So banks, just so you know, like the rule of thumb is if a bank will do it, then we will look at doing it. A bank in almost 9 out of 10 times, probably 9.99 out of 10 times, will not lend to a trust. I know because my house, my primary residence, is owned by our family trust, and the bank will not lend any money to us for the house. If we want to do a renovation, they won't give us any money because it's owned by the trust.
Yeah, I mean, I don't know about the Dodd-Frank rules. I mean, that's why we lend to LLCs, because of those regulations. So I don't know if a trust is, I don't know if that would be messing with those rules, right?
Yeah, I don't know any of that. I'd have to, that's attorneys kind of talk.
But more importantly, the risk is probably the more important aspect.
Oh, we got Gold on. What's up, man?
Gold says, last week you mentioned something about adding extra into the PUA. So for example, I recently set up a policy for $24,000 a year. Will the I team help me with putting in that extra PUA so it doesn't get cut off after 2 years?
Chances are, Gold, your policy's built for, like, the 24,000 is a mix of PUA and base. That's how we design them all. So it's probably already set up exactly kind of what you're saying. I don't think you need to be reminded. Now, if your policy's built, like if you reduced your premium deposit to the bare minimum, which is just the base, yes, you want to make sure you at least send an extra $120 or $10 a month to the insurance company so they don't take the ability to put additional money into the PUA. A lot of people come to us with old whole life policies and they're like, oh, can we put extra money in our policy? And the answer is almost always no, because you've gone past that 2-year period where you have never put any money into the PUA. And most insurance companies, at least all the ones I know of, they have a 2-year limit. So if you put no money into the paid up additions rider, that rider is no longer applicable after the 2nd year, which means you can no longer put money in it.
Once the policy is set up, we can no longer add capital directly to cash value if the policy is paid up for upfront, correct? The only way we can add cash values through interest and dividends made and the interest we choose to pay ourselves on the policy loan, right?
Yeah, because if we build your policy to hold, let's use Gold's situation. If we build your policy to hold $24,000, we're going to build it right to the MEC limit, which means there's barely going to be any room to put any more than 24,000. So to put more in, you would set up a second policy. You know, it's like you've heard me say I literally just got issued my 10th policy, which is a guardian policy. So that's number 10. And people are like, why do you have so many? I have so many because over the years, and I've been doing this a long time, I've wanted the ability to put more money through my banking system, through my policies, but each policy was built to the max. So every policy holds what it can hold, but then it can't hold any more. And if I get like a bonus or a big windfall of money, I just dump it. Like, just for example, we just sold one of our properties, which I was lending money on. So I got that money back. Now that money was from a long time ago, before I used the policies to fund my properties. So I got that money back, and probably today or tomorrow, I'll write a check to my policy's loan balance to reduce the loan. Why? Because I don't want the traditional bank to hold money when I can just send it back to my loan balance and reduce my loan and pay the insurance company less interest. So if I ever have extra cash, I just pay the loans down. Even if it's not in the scheduled loan pay down that I created, I'll still do that because it still saves me money in the end. And it keeps my money in my control and out of the traditional banks. Every time I leave or see, here's how I've trained myself, Stephen. I don't know if you've ever done this. When I look at the bank balances, like traditional banks, and I see more than 10 grand in there, immediately in my mind, I'm like, how many cars is the bank funding with my money at 8%? Or if it's more money, like our business accounts, because we have more money in our business accounts, which I constantly keep redirecting that funds. Like we take money from the business accounts. Okay, we move it into a segregated bank account within the business. We call it the war chest, and then we lend money from the business. Or I'm just now starting to do policies in the business, and then we'll lend money from the policies in the business name, and then that money goes out and works for us, so that the bank, the traditional bank, can't make my money go to work for them. Sick game. It's a really sick game.
So Johnny's still having just wanted to challenge you a little bit more. He says, still seems like you're paying twice for the car, once for the original 79,000 saved and twice for the steady payments over time.
Okay. No, I know where he's coming from with that. So he thinks he's double paying for the car. You are not. You're getting all the money back. So yes, you paid for the car the first time. You bought it for $79,900. Okay. Where'd the money come from? Came from your policy. Okay. Every payment you make back, you're paying principal and interest. Okay. The principal is repaying the $79,000. So where you're mistaken is you're not associating the payments you're making on the car to the money going back to your account. So every bit of this principal payment in this example is going back to your account. But the other factor that we're not showing and that you're not factoring in is that all $79,000 is still earning interest and dividends for you. So you're making interest and dividends there. You're making a spread. So by the math, literally how it would look is you put, let's say at 80 grand, we'll just do simple math. We'll just do 80 grand. You got 80 grand in your policy. Okay. You take the 80 grand out as a loan, you buy the car, just like we're doing, right? So you're like, okay, great. I bought the car. I could have done that with a bank account without putting the money in the policy. True. But if you did it from the bank account, that 80 grand is not earning any interest or dividends ever again. In the policy, this 80 grand, let's use Lafayette Life, because that's the lowest right now, is 5.2% that I'm earning. By today's numbers, I'm earning 5.2% on 80 grand, even though I took 80 grand out to buy this $80,000 Tesla, just rounding up, okay, simple math. Then I'm making $1,250 a month payments. Of that $1,250, I don't know the breakdown, but you know, some of it, a large portion of it is going back. So let's just say 900, I'm just making it up, is going back to my policy every month. The difference, interest, okay? That's this. We're losing that. But I made more than that. So by the math, I started making 5.2. I took a loan from the policy at 5%. So the insurance company gave me 80 grand from my death benefit at 5%, collateralized it with my 80 grand in cash value. So how much did I make? Well, by the gross, I made 0.2. But now if you were to actually look at an illustration, Stephen, and I think we need to pull up an illustration. Stephen, can you get one of those illustrations just so we can show him kind of how this is, he's just looking at things surface value. This might be your first time seeing this. You're thinking, oh, that's not even worth 0.2%. Why would anyone do that? Because it's only 0.2% early on. It's more later. You make more and more and more over time because of compound interest. So the other thing you're really, really missing here is you're not paying for the car twice. The $900 is coming back, giving you all your money back, but you earned interest on that money. And because we're being an honest banker, you're also paying yourself interest. Some of this $1,250 is interest that you're actually earning. Okay, because remember, I did the loan interest at 5.5. If 5.5 is what you charged for the loan, because that's what the car loan would have been. If you're 5 point, or I'm sorry, not 5.5, just, yeah, whatever. We did 5.5, but if you use the same amount you were paying the insurance company, or sorry, not the insurance company, the bank, 6.5 minus the 5, you're making two spreads. You're making one between what the insurance company pays you and what they charge you. You're making another from what you would have given the bank to what you actually owe the insurance company. So depending on how you want to do the math, it doesn't matter. It always balances out. Stephen, pull a sheet up just so that we can show him the mathematics of the illustration. So if you just look here, and this will pull, I'll let you run through it, Stephen.
All right, so this is just an illustration that I have in my presentation. So it's easiest one to pull up real quick without personal information. But basically what you're seeing here is this policy was 150,000 up front and then 50,000 a year going in. For 7 years, it drops down a little bit and then 17.5 going in after that. So what year is the policy? You know, it depends on what year the policy's in, depending on what this will look like.
Yeah, his policy, the case studies policy, his policies are 3 years old.
Okay, so let's just say in the 3rd year. So if we look at the increase in net cash value, so this policy each year, so in the 3rd year, he puts $50,000 in, it grows by $600. The next year they put 50,000 in, it grows by 33.78. So what we would need to do is calculate over these, what was it, a 7-year loan? In 7 years, we would have to calculate what the extra additional growth within the policy is. And then, because it's 3,000 this year, it's 6,000 this year, it's 9,000 this year. So we'd have to add that up. And whatever that total growth within the policy is over that amount of time is what we would add to the balance of what we have at the end of the day. Because what you're getting in a bank account, none of this exists. So in your bank account, that would be a big 0. In this, it would be 9, 18. I mean, I have to do the math, but it's probably like 40 grand or so. So the difference is you'd make an extra 40 grand at the end of the day with this policy, where if you use cash out of a bank, you make an extra 0. So you'd recapture the money, but you wouldn't have that extra growth. Does that make sense?
Just show the next, that one slide where it shows the actual cash on cash returns.
Oh, like in the case of investing?
Yeah, because like in this case, I just want them to see that every year you have more money. So every year your spread goes up. It's not that 0.2% in the example I gave. That might be what it is early on, but then it gets to be more and more and more.
Yeah, so this is just showing like in the 8th year. Yeah, in the 8th year of this policy, we put $48,593 into it, and it grew by $66,722. So that year, all we did was deposit our annual premium, and we made a 37% cash on cash return, tax-free, within the policy that year. And then the example we show is if you were to take that money and do a private money loan at, let's say, 12%, you would make 12% on the money in the private money loan. You make 37% within your private bank that year. You pay the insurance company 5% for a net of 44% that year. So basically, if you were to do that same thing and lend money from a bank account, you would make 12% for the year. But because you're lending out of this policy, because of the growth within it, you're making a 44% return. So basically, what would you rather do? And all we did was change one thing 8 years prior, and that's where our money was going first. So most people would put their money into a traditional bank account and then lend from there, where they make 12%. What we did is we started putting our money, instead of into somebody else's bank, we put it into this whole life policy, developing a banking system. And by making that one change 8 years ago, now everything we're doing, we're making 44% returns that year instead of 12% returns. So very simple.
Yeah, it just shows the math. I mean, you know, we get a lot of people. That's why we're creating these Excel, spreadsheets, because essentially that's what it is. Like what Craig is designing are a bunch of spreadsheets, but then what we can do is break these spreadsheets out, and anybody could buy them for a particular need. Hey, I want the car calculator spreadsheet. And then you just input your numbers from your policy, or you don't. It can do it either way. Or I want a debt calculator spreadsheet. Like, how do I pay my debt off the fastest? And you can monkey around with it. But then some of you are just too busy for that. And you're like, oh, I don't want another spreadsheet to play around with. Great. But there are people that like that, like the Wozniaks of the world. But then there's the Steve Jobs of the world that just wants to hit a button or just have somebody do it and that's the visionary, right? So for those that are like Steve Jobs, myself, I would want to pay a team to just do what I want so that it's done right the first time, so that I don't have to waste my time trying to learn, this tool, this spreadsheet that we will sell. But yeah, so it's just two different ways to look at it.
If I had an insurance license, where would I obtain additional education to design policies for IBC?
My YouTube channel for sure.
Well, Robert, yeah, so definitely go to the YouTube channel. The Infinite Banking Institute does a pretty good job. If you want to take a course, if you really want to dive into it, it's probably a little much. We also work with new agents. So if you're looking to, work with the Money Multiplier and our Money School BYOB team, I'm happy to kind of discuss with you what that would look like and what capacity, depending on what you want to do. So feel free to schedule a call with me also if you want to talk through that.
There's like 900 videos up here, but see this one right here? This is how to design a policy. So like what you're saying is if you were licensed and you want to learn how to do this, that's a great video reference.
What's the total cost to set up the whole life policy, and what is the actual maintenance cost of this policy every year after it's set up? Is there a formula of no exact line item to show cost of this?
How much you got in your pocket? We'll call that good for setting it up. Just kidding. There's no cost for setting it up. We don't charge for setting them up. We just do a call with you, find out what your needs and goals are. The annual, you're calling it a maintenance cost. It's a policy service fee is between 50 and 100 per year, depending on the company. And the cost of insurance, I don't know, because I don't know your age. I don't know your medical. I don't know your health rating. So the cost of insurance, I have no idea, but I can assure you one thing. The way we design it, we're going to put the lowest death benefit on, which is going to mean the lowest cost of insurance.
And I put the link in the chat box over there if anyone wants to schedule a call with our team to talk about your situation and setting up a policy to fit your goals and your needs. Everyone is designed specifically and specially for you as the client. So every single policy is completely different. We don't charge for any of that. So just hop on the phone and I promise you, it's not a sales call. You will not be sold anything. You will not be pressured in anything. We're simply there to help you answer questions. And if it's a great fit, we're more than happy to help set it up for you. There's no cost. We make a reduced commission directly from the insurance company, for doing this. That's how we get paid. So there's nothing there for you. And if you hop on a call with one of my money mentors and they pressure you or try to sell you, let me know. And it'll be a tough day for them. Promise you that.
Yeah. And the other thing too, Kel, like the one thing I will tell you is if this isn't a fit for you, if we get on the call with you and we can't solve a problem with this concept, we'll tell you not to do this. So everybody on my team will tell you the same thing. And I love what Aiknat said. He said, once you apply IBC to the real estate investing, we just did cars and debt today, but once you apply it to real estate investing, the returns are greatly or really magnified is what he said.
Yeah, absolutely. Might this work for an older insured, or does the life insurance cost destroy the viability of this?
After 74, it gets tough. After 72 to 74, it gets tough. I'm not going to lie, Jasper. So I don't know how old you are, but I mean, if you're under 70, it's game on.
Yeah, remember when we design these policies, we really design them for the banking aspect, which means we reduce the death benefit down, and that's where the cost comes in. So that's why people, even in their 60s, this is still an incredible strategy to use for banking, even though your death benefit might be a little less than what maybe a 30 or 40-year-old might be. But from the banking aspect, it's very, very powerful still, just by its nature. How do we connect for the 4:30 call later today? So that would be the YouTube channel. You can watch us live on YouTube. So go over to @the Chris Naugle on YouTube or @Private Money Club on YouTube. It live streams to both of those channels on YouTube every Wednesday at 4:30 p.m. Eastern, as well as every Wednesday at 9:30 a.m. Eastern. We have a show called What the F Happened, which we did this morning, where we just run through for 60 minutes all the latest news for the week, what the Federal Reserve is doing, what policy is affecting and driving your markets and your money. So the best way to be reminded of those shows each week is to go over to the YouTube channels and click the little subscribe button, the little bell, and that'll let you know when we go live each week so you don't forget. But hop on there, check those out. The 4:30 Ask Me Anything. It's a great way to continue to learn because people have really good questions, and you get to hear not only from Chris and I, but our money mentor. So the people you're doing calls with, you'll get to know them a little more personally because it is a loose show. Like, we have fun with it. It's not real like professional. I guess is the best way to say that. So we have a good time with this. You can kind of see the other side of who we are. And it also streams on Facebook. So on any of the Money Multiplier IBC channels that we run, or Chris's Facebook page, it'll stream to everything on Facebook also, if you prefer Facebook over YouTube.
These are some great questions, really good questions. What I liked about the questions is they came from a variety of different mindsets and a variety of different folks at different stages. We had some people I could tell that this might have been, one of their first times seeing this. So they had very traditional based mindsets, asking questions that most people would, like the question about the savings and, why wouldn't I just pay cash for the car? Like, yes, I didn't want to answer the question just because I felt like I kind of already did, but that was a legitimate question and a legitimate thought for someone that's just getting around the campfire for the first time. There are no dumb questions. I mean, it's just sometimes the questions just have to be massaged because we cover it. But I think of everybody on here who is doing this, which is probably a lot of the folks on here, a bunch of them had to see it a few times. I saw several comments and chats come in, that they had to see it a few times. I know that Tess, I don't know how long it took her, but she had to get around the campfire a very long time to get comfortable and build trust and see, does this really work? It sounds really good, almost too good. So I want to make sure this is real. And so for any of you that like maybe we're seeing this for the first time, just know like it's not complicated. It's actually very simple. And I think certain parts of it you're thinking are really simple, and other parts you're like, oh, all that math stuff is complicated. I did go through a lot of math, but I went through math because somebody else did all the math. And if you really just understand the general concept of what you're doing, you're taking back control of your money, you're adding a perpetual tailwind behind your money, which is uninterrupted compound interest behind your money. And you're doing exactly what you do now, but you're doing it with your banking system. You're just paying your bank back. So all these questions were really good. And I liked how it was a wide range. So thanks everybody for that.
Yeah, I was actually just talking to Chris Felix about that yesterday. We talked about a lot of stuff last week. So Felix is going to become an agent. He's been doing infinite banking now and absolutely loves it and wants to share it with his industries and trucking. And so we love truck drivers, and Felix is an awesome guy. We met him at the Private Money Club Money Tank event up in Raleigh, North Carolina here last month. So looking forward to working with Felix. And what I did is I kind of took everything that we spoke about, Felix, and put it on one document for you. And I'll be sending that over tomorrow or Friday at the latest. So once I send that over to you, Felix, we'll be able to reconnect, review it, and make sure we're ready to move forward with you coming on board and getting you started with everything. So sorry for the delay on that, but just wanted to make sure I had all my ducks in a row and numbers correct to send to you. So yeah, looking forward to that.
Fantastic. And Kel, I love this one too. This is a really good one. I'm glad we're going to kind of wrap and finish this thing up with this. Kel's asking, he was the one asking about, like, what if somebody's older? He said, I have parents over 74 who have funds that need to be sheltered. Can you still help them set up for the IBC policy by using their kids and grandkids, or is this not for them? I heard that their kids and grandkids can't be insured because they aren't making income. Now, Kel, I'd ask the question, like, if these are your parents, why not use you? Because that would benefit your kids even more than your parents doing policies on their grandkids. What if your parents were the owner of a policy on your life because you're the parent? So, not to get morbid, but there's a good chance that you will pass away prior to your children. As a matter of fact, I surely hope. It's morbid talk, but like, so by your parents doing a policy on you, they're protecting their grandchildren because you're probably the breadwinner. Not only that, they're in full control of the cash value because it's their money. And then should anything ever happen to your parents, you become the owner. So essentially the legacy, the inheritance is automatically guaranteed. You become the owner of the policy because you are the insured on the policy. Then you operate the money. So there's no probate, there's no problems with the estate. It just is an automated thing. Kel, I think that's what you should really consider versus bypassing you and going to your children, which would be their grandchildren. I think number one, it's going to be far more effective. I think they're going to be able to put more money into the policy based on you and versus your kids. Okay. And I just think at the end of the day, it's really a much cleaner and better program to protect their funds and give them full 100% control of the funds and all those awesome things that we just showed. So that would be something, Kel, I think if that's something you really are considering, I really would tell you, book a call with the team, because what you'll see with that we do a lot of planning like that for people, and it's phenomenal how it works. So Kel, I sent you over the link to schedule a call. And Chris, may I call you? I have a complicated situation. I get this a lot. Yeah, the chance of you getting me on the phone is about less than 1% all day, every day, anytime. You're more than welcome to try to call me, but I'd probably suggest this, because if you try to book a call with me, I'm probably 2 months out right now. And I'm being 100% honest. I'm too busy for my own good. It's literally me and Steven had a heart-to-heart, and Shauna and Gabby sat me down yesterday and had a heart-to-heart. I'm too busy for my own good. So I'm not trying to push you off. I'm just trying to be realistic with you. You're not going to get me. But here's how you get me. This is the best way. And it will work far better than just talking to me with your complicated situation. Book a call with someone on my team. Okay. And even if you want to request Craig, if it's complicated, or Steven, if it's complicated, I just gave you the link. Book a call. Tell them when you're on the phone, you want me to review your situation. You see, I can review a situation when I'm doing a lot of things, when I'm sitting on a webinar, when I'm doing a lot of things, I can be reviewing your situation, or I can bring it home. And when I get up at 5 in the morning, that would be the first thing I look at when I got a fresh mind before my daughter's up and before I go for a run. Like that, I would be willing to do and help. But getting on a call with me, unfortunately, has become an absolutely difficult thing to do these days. And I still want to help you, but I gotta help you in a different capacity than talking directly with you.
Yeah,
I had somebody else ask me that same thing.
I would take it one step further. If you're really serious, send me an email with exactly what your situation is, and I'll facilitate it. If it is something that Chris needs to handle, I'll make sure Chris handles it. If I can handle it, I will. If one of our money mentors can work with it, Chris and I will oversee that and make sure it's done properly. So that would really be the best if you can email some information on what that situation looks like ahead of time, and we can definitely facilitate the best way to do that for you.
Yeah, I mean, Steven, like think of the one guy, I'm not going to use his name, but the one client we're working with, like you and Carson spoke to him. You realized it was a more complicated situation with more things to talk about. So you then sent it over to me. Then what I did is I communicated with him, and now I'm still in conversations with him. And because it was such a unique situation, I booked a call with him, and I'm staying late today to do that call with him. So under situations probably much like yours, that's the process and how you do that. I like being involved in them. Steven will tell you that. I love being involved in all the cases. The problem is there's 24 hours in the day, and that's a big freaking problem. And you still have to sleep, you have to eat, you have to piss. It gets complicated. That peeing thing, man, if we could just catheter me up, I'd be a lot more effective. I drink a lot of water, and that requires a lot of time in the bathroom. Anyway, too much information, but I thought that was a cool way to end this. Folks, thank you all so very much for joining us for another week of Wealth Webinar. I hope you guys got a lot out of this case study and this real life example of how somebody else is paying for this client's Tesla, in which they will get all the money back. Join us this afternoon at 4:30 for the Ask Me Anything. You can do that by going on my YouTube channel, as Steven said, at the Chris Naugle. Subscribe and click that little bell, and you'll be notified. It's 4:30 Eastern. You will get the whole team on there. It's like the Brady Bunch, and we'll answer your questions and have a good old time. Thanks everybody for joining us. We'll see you on the next one. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.